Hello and welcome back. In this chapter, chapter 9, we'll be talking about cost of capital. We've got a mini exercise associated with this video. You'll find details later on. And we'll go through slides 1 through 14 of the chapter 9 presentation. So let's get into it. Cost of capital. So in the previous few chapters, we've been finding discount rates on various kinds of investments, right? We found a bond's yield to maturity, which is the discount rate on the cash flows that the bond generates, the coupon payments and the principal, the face amount, right? And then in chapter 6, we found the discount rate on a share of stock using the CAPM, a function of its beta and the risk-free rate and the expected market return. So cost of capital is a discount rate for a whole firm. And so we'll focus in this chapter on computing the discount rate. And then in the next chapter, chapter 10, we'll focus on like what is this discount rate used for in real life, and that'll become evident in chapter 10. So 3 steps: we find the costs, we find the weights, and then put the whole thing together. So in this chapter, we'll focus on the costs. So here's the equation: weighted average cost of capital. These W's are the weights, right? And then these K's are the costs. The notation's different in this chapter, but it's actually things we've seen before. So some of this will kind of be a review and look familiar, I hope. And then we adjust for taxes because firms pay bond interest with pre-tax dollars. So reduce if a firm has leverage, if it has debt, it reduces the firm's income tax expense. So let's look at these costs. We've seen them before, and the cost of debt, the discount rate on a firm's bonds, is the yield to maturity. So it's not the coupon rate, it's the yield to maturity. And we found the yield to maturity on a firm's bonds before. Let's review it. We use Excel. There's no algebraic formula for it. And just a brief example to review from the bond valuation chapter. Let's fire up Excel. I've got some of the familiar inputs into the time value of money Excel functions we use. So this firm has 25-year bonds. So N, when we put in, is going to be 25, and the bonds pay interest semi-annually, twice a year. So there'll be 50 semi-annual coupon payments. Right? The coupon rate's 9%, paid semi-annually. So remember, the coupon rate times the face amount gives us the total annual interest payment, and then we divide that by 2. So this bond will pay, has a face amount of 1,000 always. So this bond will pay $90 of interest per year. And if we divide that by 2, then we've got a semi-annual coupon payment of $45. And then the price is $908.72. That's the present value, negative $908.72. And then the face value is always 1,000. It's not listed here, but it's always 1,000. Right? And the firm's cost of debt is the yield to maturity. So we want to use the rate function to find the discount rate on this bond's cash flows, right? What discount rate gives 50 coupon payments of $45, and then this face amount, what discount rate gives all those cash flows of present value a price of $908.72? Well, the rate function can tell us, right? And remember, these things that went in, the number of periods in the payment are semi-annual. So the discount rate that will come out of the rate function is going to be semi-annual. So we'll have to adjust that. But let's see. Equals rate is a function of the number of periods. All these things separated by commas, right? Coupon payment, 45. The price, negative $908.72. Present values go in as negative numbers in Excel. And then the future value, the face value is always 1,000. Right? So this, what I've got now, will give us a semi-annual discount rate. So let's double that to make it an annual yield to maturity, right? Because remember, the number of periods and the coupon payment are semi-annual. So the rate function will output a semi-annual discount rate. Multiply that by 2 to annualize it, and that'll be the annual yield to maturity. And let's see what comes out. I get 10% or 0.1. So that's how to find yield to maturity for a semi-annual bond. We've seen that in chapter 7 before. So if you want to review that some more in chapter 7, assignment 2, the bond valuation assignment, there's more content there for you. So let's move on and compute cost of common stock, right? The discount rate on a share of stock. A couple approaches. We'll just use the CAPM in this class, the capital asset pricing model. This is what people use in real life when they find the cost of common stock for a firm. You could use the dividend valuation model. We looked at that in chapter 8, but in practice, it's much better to use the CAPM. So let's focus on that. And hopefully this looks familiar, right? If we have a stock's beta and we have a stock's risk and we have the risk-free rate, right? The T-bill return and then the expected market return. We've got historical data on these three things or on these two things from chapter 6. We can find a stock's expected return, right? And the math of this should be pretty straightforward. I'll leave this as an independent learning opportunity for you to work on this example, right? But if I have a stock's beta, how much market risk it has, a beta of 1.3. If the market goes up by 1%, the stock goes up by 1.3% on average, right? So if you plug all this stuff into the CAPM, you should get a cost of common stock for this firm, an expected return for this stock of 13.9%. And so the mini exercise for this video is to find a firm's cost of common stock, a publicly traded firm's cost of common stock. So you can look up its beta on a finance website, and then we'll use the historical average return on T-bills and the overall market, the S&P 500, as inputs into the exercise. You'll find details in the mini exercise. And so you choose any publicly traded firm, find its beta, and compute its cost of common stock as a mini exercise. All right, so those were the costs. In the next video, we'll focus on the weights and putting it all together. Nice work. Thanks.